Welcome to the Torch Academy. In this episode, we're looking at 3 real-world case studies, what sellers expected versus what they actually got, and why. Let us start with a restaurant. The business did $900,000 in revenue, with owner SDE of $180,000. The market analysis was $700,000 based on a 3.9x multiple. Owner thought $750,000 was reasonable. Market multiples for restaurants typically run 3.5 to 4.0x. So far, everything looks normal, but reality hit different. The business sold for $450,000, only 2.5x earnings, and it took 14 months to find a buyer. Why the massive gap? Let us dig in. The market analysis was based on earnings and market multiples, but it did not account for the real risks buyers saw. The owner was critical. This was not a transferable restaurant. The lease was about to spike. Margins were already thin, so a rent increase would crush profitability. There were 3 competitors right there, and the key chef had options. A buyer looked at all this and said, "I am not paying $700,000 to buy a risky operation I have to completely rebuild." The final offer was $450,000. Why? Because that buyer is an experienced restaurant operator who could rebuild the business, train new staff, and weather the lease increase, but they would not pay premium pricing for a risky asset. Now, case study 2. This is a commercial HVAC service company. $950,000 revenue, $320,000 in SDE, largely from recurring maintenance contracts. The market analysis was $800,000. Owner asked $850,000. Sounds reasonable, but the actual outcome? $960,000. That is 3.0x SDE, outperforming expectations. And it sold in just 4 months. Why did this one win? This business had all the characteristics that drive premiums. Recurring contracts meant predictable revenue. Customer diversification meant no concentration risk. A capable manager meant the owner was not essential. There was growth potential the owner had not pursued. The business was the clear leader in its market. Everything was systematized and scalable. When a private equity buyer looks at that, they see a platform play, the beginning of a roll-up of smaller HVAC companies. They paid $960,000, a premium, because they see strategic value. They will add units, technicians, and potentially acquire competitors. This buyer values the transferability, the systems, and the growth potential more than the current earnings alone. Case study 3 is an e-commerce subscription box service, $700,000 revenue, $95,000 SDE. Margins are thin at 13.5%. The market analysis was $400,000, 4.2x SDE, based on it being a SaaS-like subscription business. Owner asked $420,000, but the business sold for $250,000. That is only 2.6x SDE, and it took 8 months with just 2 offers, both disappointingly low. What happened? This business had almost everything working against it. Customer concentration meant if one major customer left, you are in trouble. Revenue was declining, not growing. Supplier dependency meant your costs could spike. Margins were razor thin. Any headwind would turn into a loss. The subscription box market itself is competitive and declining. Customers are not locked in. They can cancel anytime. When a buyer looked at all this, they saw a deteriorating business. They offered $250,000. The owner expected $400,000 based on a valuation model, but the model did not account for market headwinds, customer concentration, and the declining trend. The buyer who actually purchased it? A former employee who understood the business and thought they could fix it through cost reduction and customer retention. Even they did not think it was worth $400,000. Look at the range. Case 1 sold for 36% below the market analysis. Case 2 sold for 20% above. Case 3 sold for 37% below. The deviation is real and significant. This is why valuation is an estimate, not a prediction. It is a starting point for negotiation. What actually determines price? The specific factors unique to your business and the buyer is perspective. Here is the big pattern across all three cases. Valuations are estimates based on benchmarks and multiples, but actual price depends on specific risk factors. The restaurant was risky: owner dependency, lease uncertainty, competition. Price collapsed. The HVAC company was clean, systems in place, recurring revenue, diversified, growing. Price premium. The e-commerce business had deteriorating fundamentals, declining revenue, concentration, thin margins. Price collapsed. Lesson: identify your specific risk factors early. If you see something that will concern a buyer, fix it before you sell, or price accordingly. Do not assume your valuation is bulletproof. It is a starting point. Before you list your business, do this audit. Get honest about your vulnerabilities. What would concern a buyer? Is it owner dependency, customer concentration, a declining market, tight margins? Can you fix it? Some things take 6 to 12 months, some are structural. If you cannot fix it, you need to expect a discount. Calculate it. If the market analysis is 800,000 but you have serious customer concentration, you might actually get 600,000. Know that going in. Then decide, is it worth spending 6 months and some money to improve the business before selling, or do you just accept the lower price now and move on? Your answer depends on your timeline and how much the improvements would cost. But the key is, do not be shocked by the outcome. Anticipate it. The takeaway from these case studies: pricing a business is as much art as science. The same business can sell for very different amounts depending on timing, the buyer pool, deal structure, and how well the seller prepared. The common thread in businesses that sell above expectations: clean financials, low owner dependency, and a strong online listing generating a competitive process. Thanks for watching. If you found this helpful, head over to torchapp.io/signup to create your free account. Torch uses AI to help you navigate buying or selling a small business, whether you're just exploring or ready to make a move. And don't forget to subscribe for more episodes from the Torch Academy.